Guys, welcome to another Trade Genius podcast. Bob and Phil here. Guys, we had an enormous miss on consumer sentiment this morning. How big? Biggest ever. We need to talk about it. Let's dive in.
Trade Genius.
Hey everybody, it's Bob with Trade Genius. Usually I do fun ads. I talk about our service, but I want to be serious with you for a second. We've been helping a lot of people trading for a long time. As you can see here, I want to let them do the talking for me for a change. But most importantly, we want to help you too. If you've not joined our service yet, come check us out, tradelikeagenius.com. Full service. You know, we have chat room. We have the algorithms for you. We give trades out every day. We educate you. So go to tradelikeagenius.com. Check us out. What you get out of our service is much, much more than what you put into it. And we'd like to see you in the room. Thanks for listening.
So, Bob, we were all sitting around watching the consumer sentiment number come in, and all of a sudden the market just puked, and come to find out the largest miss on record for consumer sentiment. And it's kind of interesting because on one hand, there's a lot of money sloshing around, but on the other hand, I think these high interest rates are finally starting to hit home.
Yeah, you remember when Tiger Woods' mom found out that Tiger Woods got beat up by his soon-to-be ex-wife? That was our room this morning. The market was up, and all of a sudden you heard somebody yelled out, "What happened?" It was that quick. So the old phrase, peace and safety and sudden destruction, I think is upon us. You know, we've been talking for months, and it's like playing Jenga or the straw that broke the camel's back. We just got to the point now where there's no room anymore. There's no wiggle room. There's no easy answers. And I think people are just getting exhausted. And my theory is still going to hold. The market is going to crash in the sectors of the economy that are things that you like to have but don't have to have. And I'm starting to see it. You know, the gym I go to has been increasingly desperate in getting their promotions out. And it's the largest gym chain in California. And now they're offering. They were giving away personal training, and now if you buy 2 years, get a third one free. You know what that tells me as a former analyst is that they're having cash flow issues, and they want to get cash in because they know people aren't going to use the gym. But let's show the chart. I digress. So right here, people are pissed, Phil. And like I said, we're talking about this last 2 weeks. Politicians don't want to see inflation. And now what's getting embedded, the biggest worry was price acceleration. People are now starting to feel that this is not going to abate. And people are getting worried and getting worn out. And like I said, people could deal with the recession because they know a job's probably coming around the corner again soon. But they can't deal with inflation. You could be fully employed and not make it. And I think that's what's happening here. And, you know, the thing is, well, just go live where it's cheaper. Well, it doesn't really work that way. And I'll give you an example. Like, my daughter's a stylist, right? And she lives in Southern California. It costs her a lot of money where she lives, but she makes a lot of money doing what she does. And she said, well, you know, if I went to somewhere cheaper, I also can't get the money I'm making too. So it's a 1 for 1. So I don't think there's any free lunch by moving anymore unless you're retiring and moving. You know, and I think that's what's happening to people is like, where do I go? What do I do? What don't I pay? And you're seeing it in the car market too. We should talk about that. Car sales have plummeted. Auto dealer employment is crashing now, Phil. I mean, you know, anywhere across the board. The only weird thing is cruise line. Maybe people are quitting their jobs or getting fired and they're taking a cruise. But cruises are like at max right now than they've had in a number of years. But that's the only anomaly that I see. Everything else on the service-related side of business is starting to fall off a cliff. Before I get to the next chart, I'd like to let you get your saying on this.
Well, yeah, I mean, you know, the market is not the economy. The market is not the consumer. And I think we're getting that phase in the market where you get this weird dislocation, right? Because it's really driven by the liquidity that is being produced by the balance of the Fed and the Treasury and the reverse repo window, right? And really, I think Yellen is in a position where she can goose this market one more time into the election to kind of keep everything up in the air. But that being said, if things really start to break, because we've seen this in election years before, right? 2000 was an election year, not a good year in the market as we head into Q4. 2008 was an election year, and that started breaking, I think, in Q3. So there are things that sometimes you just cannot stop. And if it becomes systemic, meaning that we start seeing credit issues start to spread across, you know, into Europe and Asia, you know, we're going to have a situation where it's not going to be, it's going to be insurmountable insurmountable no matter how much T-bills she wants to pump into this system. So it works until it doesn't. I think whenever you have a situation like this where the forecast is so far off, this is where black swans come from, because you typically, if you look at the actual versus expected portion of this chart here on the upper part, now you'll notice there's a black line and an orange line. I mean, they're generally always within a few points, right? Usually 1 point off, maybe sometimes 2. If you get 3 points off, that's kind of an outlier. We were off like 8 points here on today's number. So this is where black swan things come from, because they're just obviously missing the boat here. And this one is notable because it's usually the forecast is very accurate. So that tells me that things are breaking that they're not on top of, Bob. And that is the one concern here. So while I think we can still get a blow-off move, and it's going to be mainly derivative driven and leverage driven, we can't discount the fact that if we don't really start seeing this move up, maybe this is all we got so far. Maybe the high's in.
Yeah, it's kind of scary, and you know why they're doing this. You know why these forecasts are wrong, Phil. We talked about it this morning in the room as well. Why is Jerome Powell saying things that are just patently false, and the gaslighting is so prevalent? Is that everything's AI driven now? Everything's based on algo driven. And so if somebody had a forecast that matched this result, I guarantee you that, and that got kiboshed by the politicians, right? In the University of Michigan, they're like, we're not going to produce that. What are you doing, right? And then we'd rather be surprised. And these are the kind of divergences we've been talking about for a long, long time. And speaking of black swans, Phil, this next chart I'm going to show you is that there's no wiggle room for companies either. This is the Russell. The percentage of companies that are not making money is 41%, Phil. 41%. Remember a year ago I was telling you it was 25%? It's now 41%. Why that matters is that we're having credit contraction. So companies that aren't making money, okay, and they can't extend their bank lines, they have very few options in which to stay in business. One is they can, if they have a lot of debt on their books, they can swap equity for debt, but that drives the price of their shares down. Or they can rationalize their business if they have the right mix of fixed and variable costs, that they could take out enough variable costs and still be able to, make a profit in the business. But that also cuts revenue, okay? And it's obviously the short-term fix, right? Or the third option is you sell yourself off, but we're going to start seeing take-unders versus takeovers. And the last but not least is that these companies just go get vaporized. I think we're going to see a combination of all those things. So that's the Russell, headline stocks. You don't see that till the very end, but that's the rot that we're having underneath. And you know what? The FANG stocks have been struggling, Phil, in this move. They're not leading. And the other thing we noticed too is whenever that 10-year gets over 450, it's some sort of pivot now, because you usually get interest rates up, oil up. Now we're getting interest rates up, oil down. And that's to me, that's an alarm bell. That's another divergence you got to pay attention to, saying, okay, that correlation is breaking down. Why is that breaking down? Because we've got the best out of that. And so people now are not worried about inflation so much. Now they're worried about higher interest rates destroying economic activity. And when energy rolls over, we know that's the last dog to get thrown into the pound, Phil.
Yeah. So, again, this is just, this is kind of unprecedented, really. 41%. If you look at the chart, historically, we are at levels. It's just mind-boggling, actually, that we are trading where we're trading at in the stock market. To be honest, boggles the mind that we are able to do this. But I think it shows you how much you got zero DTE options. We saw a thing. I think J.P. Morgan said that zero DTE retail volumes are back at very elevated levels. I think it's turned more into a casino here. It's not going to end well. These episodes, it's a lot like the end of 2021, to be honest with you. But they've also, I think the difference here is that we were going into a different regime where we were going into the Fed not accommodating, and Yellen had to pivot a little bit on how she was going to handle that. And she also has now figured out, how the T-bill relates to leverage in the system. So I think she's going to use that as an ace up her sleeve to try to prop up the market, but you don't want to blow that too early. So I think we've seen that. We saw the net liquidity drop, which means she has not been issuing as many T-bills as she once did, like we saw the last couple of past quarters. But I think she's delaying that for when she really needs it, if she has to goose this market in Q3 to get, everything looking rosy ahead of the election. But the administration has a tough task ahead of them. And that, I mean, when you have a miss like that on consumer sentiment, what are you going to do? That's your whole economic philosophy is getting thrown out the window in the worst possible time for you.
Yeah, and it's to his base too. His base is feeling it the most, so it's going to be really interesting to see. And I mean, and the headlines are Bidenomic fails. So, it's going to be really interesting to see what they do. Look, we're pushing on the string now. This is the pushing on the string that she can throw as much liquidity as you can, but it's like throwing water on lithium, right?
Right.
It's just going to flame up against them. So anyway, guys, we'll be back tomorrow with more stuff. Didn't mean to be this gloomy. Look, Phil and I, we desperately want to have this final hurrah so that we can enjoy Sold to You, but they're having a hard time getting this thing up. And so it's going to be really interesting to see how we get into the summer and see where this goes. So just be careful. Don't take unnecessary risks with your portfolio. And if in your own personal life, be really, really careful, how you're doing your spending so that you can survive. Because I think this is not going to be a run-of-the-mill recession, Phil. There's too many things coming at us demographically and financially, economically, geopolitically, that this could be a longer retrenchment. It's going to test people, and you need to have enough runway and liquidity yourself to be able to survive it, then thrive into the next upcycle. With that, Phil, thank you so much. We'll see you guys tomorrow. Check us out. We're doing really well in the room. This volatility is our algos are eating it up, and we'll teach you how to use it. We'll throw you some trades and get in a room and ask questions, and don't be a mushroom. Talk to you later.
Trade Genius.